Welcome everybody from all corners of the world to the very first TrueDil webinar. Thank you very much for joining us, and you're very welcome to listen to the recording afterwards as well. So I just want to, before I introduce our distinguished speakers, David Pearce and Jeff Lermer, I just want to talk to you a bit about sort of housekeeping, the schedule, what we're doing. So first of all, David Pearce is going to speak for 20 minutes and outlining the true value of intangible assets. And then Jeffrey Lermer, so David Pearce is he's Managing Director of Knowledge Ecosystems, and so he's the architect of the methodology behind intangible assets. And then Jeffrey Lermer, who's an M&A specialist and also accountant and tax specialist, he's going to challenge some of the assumptions. And then you're going to ask questions for 10 minutes. So if you have any questions, you can find at the bottom of the screen, you can just put your questions in chat with your name. So put your full name and even your company if you want to, and with your question. If you want to attract attention and ask a question in the middle of the presentation, please, there's a button on the right, which you can press, but with reactions, so you can just put your hand up. That'd be great. And then afterwards, after your Q&A session for 10 minutes, David's very kindly offered to give you sort of a complimentary sort of deeper dive session, which you can book in with him separately, individually afterwards as well, if you want to do that. That's his complimentary session afterwards. So just thank you again. I hope everybody's on now. So I just want to explain a bit about TrueDil. We've done other events, but this is our first webinar, and we're a global networking, discussion and sharing platform and forum. So we focus on the importance of non-financial due diligence. Okay, so non-financial due diligence, which enhances traditional financial and legal due diligence, adds value to that. We're also a network of change managers and non-financial due diligence specialists who help different companies, large corporates from scale-ups, large SMBs, even startups in different areas. So it's a huge area, and we believe obviously it's gaining precedence. And obviously we're excited about this because we feel that intangible assets are becoming more important as part of innovation, and innovation is capturing people's different talents, people's skills, whether they're software developers or having soft skills which add to the bottom line. They might not be visible. So that's why we're very, very keen, and we think hopefully we'll get enough interest and feedback and discussion from you. And we're going to also open a LinkedIn group which you can share thoughts, so we can continue our discussion afterwards. So I'm just going to hand you over to David Pearce, Managing Director of Knowledge Ecosystems, and he used to be an architect, which is really interesting. He's not an accountant, but he suddenly, from doing different projects, he came up a brainwave for this idea, and he's developed it over the years. So he's just going to talk you through it. Welcome, David.
Brilliant. Thank you for that introduction, Charles. I'm just trying to share my screen. Okay, does that look okay to everyone? You can see the first slide?
Yeah, perfect.
Yeah, brilliant. Thank you. Okay, well, first I'd just like to go through sort of some of the background information on what kind of value is captured on a balance sheet, just so we understand sort of the terms I'll be using throughout the rest of the presentation. So what I've done is I've set up some very straightforward and very simple diagrams just to represent the different types of assets on a company's balance sheet, and also where there may be hidden value. So we start off, and obviously you have your tangible assets. That's fairly straightforward. There's something there to measure: company vehicles, plant and machinery, office equipment, those kind of things, all very straightforward. Then on top of that, there's these things called easy intangibles, or I've classed them as easy intangibles. That's the kind of things that most companies have on their balance sheet. Software is sort of the classic one, but it's a very short list. Pretty much software is the only one that people use. And then surrounding that, we sort of have uncaptured intangible assets, and that's this sort of mist of value, which is kind of very difficult to grasp and to actually capture. But that's obviously what we're going to try and talk about today. And then my view is what you can do out of that fog, out of that haze of uncaptured intangibles. There are some what I've called difficult, because there is a skill to trying to capture those intangible assets that you can absolutely capture and put on your balance sheet. So how the levels of intangibles differ. So I've used, in the first instance, I apologise if it's not from your local area, but I've basically done the US first because they've got some really good records that go back quite some time, and then I compare it to the UK. So back in 1975, the average amount of intangibles on balance sheet for sort of the top 100 companies in the US was 17%, so quite low. By the time you get up to 1985, that's moved to 32%. Can you see that's almost doubled in about 10 years? Since then, it's actually moved up to 84%. So that's where the average US company is at the moment. And then right at the very top, the top 5 businesses in the US have 95% intangibles. And at the time of this data, that was your Apple, Amazon, Alphabet, Microsoft, and Facebook. So as you can see, they are by far, intangible businesses. They have next. I mean, their tangible assets are still very big because they're very large companies, but as an overall percentage of the business value, it's quite small. So those diagrams are all the same size. So what I've done is I've sort of just tried to explain it graphically what the differences would be. So the first one is the one you've seen already for a 1975 company. As you move to 1985, you can see the pie is getting bigger. And when you come to now, it's quite a big increase. So to put some numbers on that, if you're a business with a 1975 level of intangibles and you're worth $10 million, if you manage to increase your intangibles up to a 1985 level, you'd now be worth 12.2. And if you manage to get up to the average, you'd actually be worth 51.9 million. So you can see it's a big impact. That's 5 times the initial value of that business by, changing the levels of intangibles. So how does that compare to the US? So as I said, US average is 84%. The UK average is 22. So you can see it's a quarter of the level of the US companies. So it's quite a lot lower. So, what are the realistic increases to the UK levels? Using some information produced by the HMRC, going from the 22%, they think 64% is a realistic achievable target. So the HMRC document actually references a CIMA document from a few years ago. So again, that's quite a big increase. So again, using the same thing about how does a pie look? If you move from 22 to 64, you can again see it's quite a large increase. And again, if you put numbers, so if you're again an average a UK company worth £10 million with an average level of intangibles, and you manage to move it to the 64% target, that more than doubles the value of your business. That goes from 10 million up to 21.7. So again, you can see that's quite a large increase. Sorry, just something's flipped in the corner of my screen. It was just the chat. Okay, so what is this hidden value? If I can get back onto the right screen. Okay, so going back to that diagram we had before, we've got this, as I said, this sort of mist fog of uncaptured intangibles. Within that, you get these sort of areas where value starts to coalesce, and it makes it a little bit more easy to capture them. So using my sort of easy to difficult words, these types of assets are captured by the HMRC in their document. So it starts with your accounting one, so your software, which again I've mentioned before is the one most people probably have on their balance sheet. There's some development expenditure and there's licenses. You then move on to it. So these are getting more difficult as we go down the list. So then you move to intellectual property rights, such as patents, trademarks, copyrights, and designs. onto intellectual property, such as brands, R&D, cultural assets. And sorry, it keeps flicking over to the wrong screen. Then you move on to statistical intangible assets, such as organizational capital, training, and data. And then the one at the end, you enter with knowledge assets, such as know-how, methodologies, expertise, and algorithms. So what's worth noting, as it says at the bottom there, is not all of those can be captured on the balance sheet in the UK. So there is a different requirement around the world, but in the UK market, as an example, brands that are self-developed are not allowed to go onto balance sheet. Certain organizational capital, such as customer lists, cannot go on there. Any training costs, again, these are all expenses. They cannot go on a balance sheet as an intangible asset, but that still leaves a lot there. As I said, as you can tell by the name of my business, where I'm interested in is the ones at the bottom, the knowledge assets, such as know-how and so on. You know, which takes us back to the slide we started with, or the image that Charles set up for us with the brain there. So these intangible knowledge assets basically fall into two broad categories. There's the knowledge retained by people, so that's their know-how and their expertise, you know, the skills, that's the reasons, things people put in their CVs, the reasons you employ them. And then what you also do then is you work up that knowledge into captured forms. So that might be a procedure or a process. You might actually develop a product or actually a piece of software, because if you think about it, that's all the software is captured knowledge. You know, someone wanted a computer to do a certain thing, and there were individuals who could do that, and they spent time capturing that in a more tangible form, which is still an intangible asset, a piece of software, so that piece of knowledge can be used over and over again. So I'm just going to go on a little bit about the taxable basis for the knowledge ecosystems approach, and basically the approach to intangible assets. So it basically starts with the IAS 38 standard, which is entitled Intangible Assets. That was published back over in 2004. And then in the UK and Ireland, we've now got the FRS 102 from March 2018, which is the financial reporting standard applicable to the UK and the Republic of Ireland. Basically, the FRS 102 document has implemented a common agreed understanding of the IAS 38. And they're set out in their section 18, intangible assets other than goodwill. So that's where it is. IAS has a really nice definition of intangible assets. It basically says intangible asset is an identifiable non-monetary asset without physical substance. It's an asset that is a resource that is controlled by the entity as a result of past events, for example, purchase or self-creation, and from which future economic benefits, such as the inflow of cash or other assets, are expected. So this basically gives three critical attributes to an intangible asset. That is identifiable, i.e. you can put a line around it and say this is what this asset is. That you control it, so you can do things with it. You don't have to ask anyone else's permission, such as pay a license. And that there is a future economic benefit is expected, so you can use that to increase revenues or reduce your future costs. So in summary, the FRS, as I said, has a slightly different take on the IAS. It's a little bit more pared down. But basically, many types of knowledge can be classed as intangible assets. They need to be valued at their initial cost. They have a finite lifetime and are amortized over a maximum of 10 years. Past expenses cannot be recognized as an asset, so you cannot go back beyond the current year to capture those costs, though you can use work in progress on an asset going forward. So it might take you 10 years to develop an asset, but you're allowed to capture those costs as an intangible asset as you go forward. There's also a number of sort of very technical requirements that need to be met, which the knowledge ecosystems approach fulfills. And obviously, if anyone would like to take this further, I can go through how that's done. So just as a bit of fun, and I know Jeff's going to pick holes in this because it's an architect trying to do accountancy work. I've sort of done because where this came from recently was this HMRC document, which is all about the intangible asset value of government assets and the knowledge they have. So the government have got an interest in this. And so I've just done a bit of fun just working out, what could this be worth to the UK? So again, these are all 2019 numbers. So they're probably not through now, but they were just some months ago. So in 2019, there were 33 million people employed in the UK. Their average salary is over 36,000, and I know there's lots of different versions of that, but this is the one I've used, which gives a cost of £46,000 each. Now, cost is important. That's what you can actually capture as the value or use for doing the valuation. So it's not the salary you give someone, it's the whole cost of employing them, such as cars, pension, etc. So if you assume that 20% of these employed people spend 10% of their time developing knowledge and creating value in that way, that's £30 billion of unclaimed assets a year. And the GDP last year grew by 70.5 billion. So using this, what I think is a very conservative estimate of 10% development time only for 1 in 5 people, that actually allows GDP growth to be to increase by an additional 42%. So these are quite big numbers in the macro scale. So what are the implications for the M&A sector? So the points of interest, I believe, if you're looking to buy a business, you need to have a full understanding of its value. And you need to understand how that business creates that value. So there may be teams that are hidden from you that are critical to the ongoing success. So this is the knowledge, the knowledge assets that a company has. If it has, some development teams that are making, improving things or making things better or creating the products for the future, you need to know who they are so you can look after them. And if you bought the company, obviously it's quite helpful to increase its value. So if you're looking to sell a business, you want to maximize that value. So again, that's about capturing some of these assets and getting as many as you can onto the balance sheet. So how much value is actually hidden? So again, this is using some data. This is global average data for the last 10 years. So the tangible assets, so that was the blue circle at the start, is 48.9%. The disclosed intangible assets, so these are ones like the software, things like that, that people have actually put on their balance sheet, excluding goodwill, 6.6%. And then goodwill on top of that is another 8.5%. So again, these are global averages. So that actually leaves an undisclosed intangible asset value of 36%. So that's over a third. So in summary, less than half the value of is classed as a tangible asset. So that 49%. And of the 51%, 44% is unassigned to any asset. So that's basically a goodwill, which is obviously a very loose term for value, and the undisclosed intangible assets. So again, these are very big numbers. This is just a slide just to show how that's changed over the last 10 years. So you can see the impact of the recession back in 2009. And then since then, in 2016 and 2019, even though we weren't obviously in the same under the same stress from a financial point of view, there is an issue there where people have valued companies more on their tangible assets than their intangibles. So their intangible, the undisclosed value there, that goes down. So what is this hidden value? Is it a product? If so, can it be easily replicated by others? Is it a set of processes? If so, are they being maintained or are they fast becoming out of date? And is it people? And if so, what stops them walking out the door? So this is basically saying there is this 50-odd% of intangibles. When you know what they are, you can start valuing them and you can start protecting them. And obviously none of these questions can be asked if the value remains hidden and unassigned to an asset class, which is, like I said, what I showed in the previous slide, where we are at the moment. So what's the additional value you can unlock by capturing what you know? So when you know what you know who knows what and therefore who to protect. So again, that's going back to that thing, if you're buying a business, you need to know who's adding the value, who's creating the future value, and making sure that they either stay a part of the business or you protect them as well as you can. You will know what you don't know and therefore where to invest. So when a company has holes in their knowledge and they're looking to move into a new sector or continue to build in the sector they're in, they need to know already what they've got and therefore knowing what they don't know, so therefore they can work out where to place their investments. And also you can bring this knowledge together to create new offerings. I've got a history of working with very large businesses, over, I think the largest company I've worked for was sort of 200,000 people. And that's the problem companies get when they get to, well, any size over about 50 really. It's very difficult to know what you know. So it's very difficult to understand that you don't need to go out and buy a new business. You don't need to go out and employ new people. You may already have that knowledge. So it's about capturing that, so understanding what you have. And then just as importantly, you can reuse this knowledge to increase your effectiveness as a business and therefore increase your productivity and profitability. And also quite importantly, certainly with the way things are at the moment, if people are leaving for whatever reason, through retirement or change of career or whatever, you can, when you know what they know, you can try and capture what it is they know, maybe turn it into processes or train up other people in the skills they have before they leave. So how knowledge ecosystems differ. So what we do, we don't compare you or any business to similar firms and make an estimate of intangibles. We actually undertake a bottom-up review capturing the real IP that a business has, which allows them to be added to the balance sheet if required, not just be a standalone estimate. So there are reasons why you may not want to put your value on a balance sheet, and I expect we'll go through that with Jeff in a moment. And as real intellectual properties are captured, they can be used to create more value. So sort of the final stage, the step for us is we don't estimate what value there might be, we capture what there really is. So Charles, I wasn't sure whether we ought to go to question and answers now or whether Jeff was going to do a short presentation.
Yeah, I just wanted to ask you one question, which is, first of all, the HMRC, do you have any idea when the HMRC are going to take this quite seriously? Because you mentioned previously that they're looking at it at the moment.
That's right, yes. They published a paper back in November 2018. So they're looking at it, certainly looking at government departments to come forward with this. But I've not managed to get in contact with the authors yet to find out, because obviously this is a real thing. You're allowed to do it under financial reporting. So I think at the moment people haven't done it because it's actually very difficult, or it has been up to now very difficult to capture what these assets are. So it's certainly allowable. And I think the government, if you went back to the government and said, we can increase GDP growth by 40%, hopefully they'll respond by bringing in some tax incentives to allow you to, to actually capture those without paying too much tax.
And the Financial Reporting Council, we don't know whether they are taking it very seriously, because the IFRS and the states are taking it very seriously. Do we know that?
Yeah, I mean, because we can see from obviously the numbers in the states, they take a different approach to what intangibles can be captured and reported, and they certainly go with brands. I think it's one of the main ones, difference in the UK, where if you buy a brand, it's got a value. If you make the brand yourself, it's got zero value on your balance sheet. It's a very strange situation, but I imagine that was done. Something would have happened where that sort of worked against the common good, I guess, of what the government were after. So they've kind of outlawed that at the moment.
And by the way, just to everybody on the way, if anybody's from the far Asia Pacific region or the Latin American region or the Middle East region, and they have any ideas, they can give us any feedback what the different treasuries or government organizations or accountancy bodies, how they view intangible assets. That's really valuable for us because we're trying to glean and gather information on a global basis. That'd be really good. So please, before, I think we go straight on to Jeffrey Lermer.
Okay.
And then, but please don't, again, at the bottom, you can see there's a chat button and you can put your question in there and we can do that after Jeffrey's spoken. I'm just conscious of time, so we'll just keep going. Thank you very much, David. Brilliant.
That was pretty good. 20 minutes, wasn't it?
Thank you.
Excellent.
Right, hello there. Right, good to be here, and I appreciate that. And that was a really, David, an interesting presentation and interesting ideas about what you're trying to achieve. I just wanted to stand back a little bit about, I suppose, the purpose of accounts. Why do we have accounts? Because if we know what they're trying to achieve, then we can say, do they meet the objective or do they not meet the objective? And I think they're not used as a basis for preparing a valuation. So if you think about sort of what a business is worth and all its individual assets, the fact that there are assets within it that aren't necessarily disclosed isn't necessarily massively relevant, as long as the whole point about a set of accounts is you could be able to compare one company with another on a very solid foundation. And the trouble is when you're bringing in a degree of, where nothing's objective. So we're making a subjective valuation, comparing two businesses, and one company values it in one way, one company values it another way, or one company values it something and one doesn't value it at all. It doesn't necessarily mean the companies are a different value. It just means it's not shown in the balance sheet. So I want to sort of get that sort of thing across. They are typically massively hard to capture, and I just want to. So I'll switch onto my presentation now. So let's go and do that. So we're with that. So I just wanted an overview of where we are with valuations and intangible assets. When we buy a business, when people buy a business, because that's the bit where I'm more involved in, you need to be very sort of specific about the assets you're acquiring. And that, you know, what are you, sometimes you're buying the shares, sometimes you're buying the assets within the company. And I completely get the importance of actually showing you need to bring that in, and you need to sort that out. So it's really, I think, it's really important to do that. But it's a matter of saying, what are we trying to achieve when we're valuing a business? And I think it's actually sort of showing all that's really important. On the next bit, the price. When you value a business, when someone buys a business, what are they actually doing? And sometimes you have to value a business for a particular purpose. There may be a shareholders dispute. There may be an option to invite employees to become part of the business under an EMI scheme, something like that. So when do we need to value? What we're looking at to try and value the business, and what we look to do on a valuation purpose is actually see, all we're trying to do is actually, what is the current value of the future income that's going to be generated from that business? And there's a number of ways of doing that. There may be a typical multiple if it's a particular type of business. And maybe a turnover multiple. If it's a construction company, it's not very big. It's really what's been contractually agreed. If it's a financial services company, it's funds under management, whatever. So there's certain industries that are valued based on what's, you know, a turnover or what's within the business. There are other businesses that are, you know, in order to value, you might value it on the assets, and a property company is typically something you'll value on the assets. What's the value, the market value of the assets with the properties within that business, take account of the tax on it, and that gives us our market value of the business. And for trading businesses, what you tend to do is we look at what we believe to be the maintainable profits. So we might look at the past, what did the company do in the last few years, and actually based on that, what we think it's going to do in the future. So that's our sort of maintainable profits. And then we apply a multiple to that. And the multiple varies depending on various things. It will be a higher multiple if the business is expanding. You know, if there's two businesses, both have the same maintainable profits, but one's growing at 30% and one's not growing at all, clearly the one growing at 30% is going to be more value. So you apply a higher multiple to that number. And historically, that's how we value businesses. That's how acquirers value businesses. And the stock market in the same way. What are you doing? You're actually saying, I've got some shares, I will get some dividends, because, you know, as a small shareholder, all you're going to get is the income from those dividends. Sometimes you've got companies that haven't paid any dividends for a long time or ever. So what they're then doing is you're still estimating at some time in the future it's going to start paying dividends. So the price or the value of a business is our estimate of the future cash flows that's going to be generated as a result of owning that business. And this is really relevant. What we think we're buying, that's really relevant to what David said, is because, and I've done this from a sort of due diligence point of view, but actually, yeah, you can see from the balance sheet what potentially, with UK, what the traditional assets are, and then it's actually seeing what the other assets are, what the other good things about in the business are. So if there's a structure if there's a mechanism to supply sales through a particular way. So one of our clients, for argument's sake, had a mechanism of they had a distribution agreement to supply services to the armed forces. the armed forces didn't have many of those agreements, only had a few. That business was massively valuable as a result of that particular method of distribution. The whole company valuation was based on that. It wasn't necessarily what that company was actually delivering. It's what a future acquirer of that business could bring in. So that's where we are, where what we think we're buying, and add those sort of numbers in. From a UK point of view, and I'm a London accountant. I'm tended to be motivated about putting things on the balance sheet very much from a tax point of view. We sit in the small, medium-sized businesses, and just for example, if somebody was to spend, I said £500,000 on a system in this example, now that system may qualify for research and development tax credits, but if we put that on the balance sheet, we won't be able to claim tax relief. If we put it through profit and loss account, we will. So there's a massive incentive to put it through the profit and loss account, a massive incentive to not do what David says, or add value by doing that. And until I think the system changes, until there's actually specific legislation to say, not just when you look at the item to claim tax relief on, you actually look at the type of expenditure, not how it's allocated in the accounts. Until that happens, I think there's a massive disincentive for businesses to capitalize all these things. The only time I'd say against that, or typically against that, is when you have a new startup, especially a sort of a funded startup. There's a massive incentive to actually show to the investors what they're doing is value for money. And at that stage, tax isn't so important because maybe they're not making a profit. So you'd want as much as possible to capitalize as many of those costs as possible, and show them on the balance sheet, because then the investors are going to feel a bit better about themselves. But I didn't want to sort of finish off with a problem and not come up with a solution, because people who know me know I'm very much sort of solution focused. So if my solution, because if I'm not going to be, if a client's not going to get a tax benefit by doing something, I'm not going to be massively incentivized to do it. But what I'm suggesting is actually potentially either add additional disclosure into the statutory accounts. And that's really straightforward. And as long as it's not misleading, if the auditor's forming an opinion on it, he's going to make sure it's not misleading. And it potentially even create a second balance sheet to bring these assets in. So effectively what we've got is two balance sheets. We've got one set of accounts based on assumptions that follow the FRS or whatever, and maybe in a more harsh following to ensure they get tax relief. And the second one actually say, you know what, we've got these assets, we've got 5 people who've been working on this system for 3 years. The value of that system, just the cost value of that system is 400 grand. We need to show that on the balance sheet. So as a result, we can actually show both. And as long as one isn't misleading, we can get the benefits of what David's trying to achieve without actually having the tax cost. I've referenced in there a LinkedIn post I did a few days ago. The LinkedIn post is it's a funny old post, but it was about valuing businesses. And actually, if you want to create your business, a business to sell, my view under that was actually produce a set of accounts that looks like a set of statutory accounts. So you take the original underlying figures from the statutory accounts that we would produce, and you go to a sort of a graphic designer, get your photographs around it, get your chairman's statement in it, and add anything additional that adds value into it. And I think there's lots of ways of adding value into things. And you're adding, one of the ways of adding value in will be exactly as this. We've created this system, we've done this, we've created this brand. In our opinion, the brand is worth whatever it is. It can't be misleading. That's obviously, you can't put a figure in a set of accounts that is misleading. So as long as you're backing up and being consistent, I think that's a really good sort of, I'd say, halfway house to positively show what the assets in the business are, but without being penalized from a tax point of view. Because nobody, typically, one's always very concerned not to do something from a tax point of view that is just That any disincentive against tax is going to stop people doing it. The government are great at manipulating or buying decisions via tax. So at the moment they've created a structure that does not encourage businesses to capitalise these assets. So as a result, I think that's why we've got the system in the UK. US is different because we're not encouraged to do it. It will be the easiest thing in the world for them to encourage us to do it, simply by saying, well, actually, we're going to look at the nature of the expenditure, not where that company has posted it. So I think there's a real way of of getting to that solution. But my only concern about that is the comparability. As a set of as if I was auditing a company and they had something in the balance sheet and it said, X number of people have created this asset, then we've got a number in that balance sheet and we're sort of bound by that number. I would then, as an auditor, need to go to a third party to agree the valuation of that number. I don't know if it's right or wrong. I'm not expert enough to do that. And so it would potentially give a burden, but give a cost to the company to actually do that. So we need to be a little bit mindful of that, and without easily comparison, it sort of doesn't work. You've got to be able to, when you look at two sets of accounts, you really want to make sure they're on a level playing field. They're produced in the same way. That's why typically when you value a business, as I said, what you're trying to do is multiple of profits or maintainable profits, and you do a typical EBITDA calculation, because the depreciation, people depreciate assets over a different number of years. One company might depreciate an asset over 40 years. One company might depreciate it over 3 years, and it's the same asset. So for valuation purposes, you ignore the fact of depreciation, you ignore the fact of other things like interest as well, because the way companies are financed isn't really into the value of that business. So that's what it's an interesting topic, and there's a sort of lots of areas to sort of consider. But I do love the idea of companies creating assets and acknowledging they're creating assets, because what they're doing is saying to the outside world, I am creating value. I'm creating something that's really, really good. I'm creating something that actually massively adds value to my business. And I think that's really positive. And I also like sort of what David said about, you can actually learn then if you've got gaps in a particular area. So that was my take on this topic. In the slides that I've done, which I can forward across to sort of get shoved in, I put my contact details if anyone's interested, but it's not about this. It's just about here we're here to debate and find out, what should we do and how should we present it. But I think we need UK wise, we're going to need a wholesale change in the tax rules to encourage us to do that. So with that, I'll now pass I'll pass the host back. I can see how to do that,
Thank you very much, Jeff. That's very, I learned a lot there, so really helpful. And we got a question from Belinda Wong, and it says, for those intangible assets which do not have some kind of market practice in valuing them, will this delay the buyer-seller agreement of their value? Hence, delay in concluding the deal or even destroy the deal. Do you understand that, or do you want to speak to? Maybe you can speak, Belinda. If you want to put yourself on mute, maybe you can identify yourself and speak to Jeff directly, or maybe you're on.
I can take that. There's enough information to take that. The delaying any transaction. The fact that the seller is saying my assets are worth this, that doesn't necessarily mean from the buyer's point of view that they're going to accept that number. So it shouldn't. I don't think it will put any delay in whatsoever. The buyer's going to put in an offer for a number that business works at, that it works for them at. The fact that someone's valuing. See, I think even if we take account of the cost value of these assets that are being produced, even if we take account of that, even if we don't depreciate it, I don't think that's going to be the value of the business. That's going to be the cost of producing those assets. What actually people are buying is the future cash flow that's being generated. In fact, something's brought into my mind, which actually potentially is quite interesting. And if you're looking to buy a business, and let's just say a business has created something that's a bit special, if they are valuing it at cost, they are acknowledging that they've spent X amount to create this system. Well, from a purchaser's point of view, they might think, well, actually, fine, I can see that business has spent £600,000 to develop this product, because I can see that's on their balance sheet, or they've shown that's the number. Well, you may be loath to pay any more than that, because you think, you know what, I can go and pay £600,000 and get it done myself. What am I buying specially from that business? Then maybe it might be potentially counterintuitive. So it might not necessarily help their relationship. But I don't think it would delay it. I think when people are ready to buy, they're ready to buy. They put the offer in. I don't think they're gonna specifically argue about that. When you do due diligence, typically if you look at a sale and purchase agreement, you have part of it. There's various things in there, but you agree a net asset value of the business. I will supply with you. Now, what will happen is typically you say, net current assets are this amount, and fixed assets, whatever. You state what they are on the purchase. That way, it may well be the business has, I'll pick a number, an extra £4 million worth of cash in the business. That cash doesn't need to be sold. It can come out prior to the sale. So there's, what are you going to leave within the business? And I think that bit of it, I suspect when we've got items like this that are very subjective to value. Well, if I was doing a sale and purchase agreement, I would just exclude them. I wouldn't try and get a kick value on them, because it's not going to come up. We're not going to be so. I do that typically with fixed assets in the sale and purchase agreement, because the actual cost value or the depreciated cost value is pretty irrelevant. Do they work? Do they fit in with the business? Do they allow the business to do what it does? Fine. I don't need to sit there and value that and say you're going to pay you a bit less because the value is a bit lower. I'm agreeing to buy the business based on the fact they're all working. So that's how I'd say it.
Good, thank you very much. We got another question from Roy McFarlane. So from Total Productivity Company, a manufacturing specialist. So how does a business account for intangibles when they are preparing for sale? Can this be done after the fact in a similar way to R&D tax credit evaluation?
Want me to do this one, Jeff? I mean, as I said in the thing, you're not allowed to capture anything that's already been covered as an expense, as an intangible asset. So you could, unless you held on to that value as the building blocks for that asset, you would lose it, because it would just become classed as an expense in past years. If you want it on the balance sheet, of course, as Jeff was saying, you could do this separately. We're developing a product called a KEV report, which is sort of the Knowledge Ecosystems valuation report, which would have a standardized way of capturing all of these things, by asset class. So it would be like the thing you would put on your balance sheet if you wanted to, but obviously, as Jeff said, you probably wouldn't want to.
Roy, does that answer your question? You can just say chat yes, or you can talk. Any other questions that people would like to ask? Okay, well, we're okay. So message from, sorry, another question has just popped up from Jamie Robinson. Hello, Jamie. If assets all depreciate and in-house software systems are assets, what model can you use for the depreciation in value of these software systems? Obviously, these systems don't wear out in the same way as physical assets. From Jamie Robinson, I'm assuming.
Yeah, I can give you the answer from the sort of the accountancy documentation answer, which is if you don't know how they devalue, you use a straight line. My view with anything that's an intangible asset is it loses very little value in the early years and then tails off quite considerably towards the end. But anyone who uses Microsoft will notice now, you buy the software and within 3 years they're telling you it's not going to work anymore. So they obviously want to move you on to a subscription model. So software does go out of date, but again, I've got pieces of software I've had for 10 years that still work for me. So yeah, you can make your own judgment on that.
And I think we discussed before, David, what Microsoft, isn't it 69% of their assets are intangible? Something incredible.
That's
like
right. Yeah, it's massive. Yeah.
Massive, yeah.
Hi, this is Jamie. If I could come back to that. So this is from the point of view, I'm a startup which has made software. Basically, I'm a good old newbie tech startup. So it's not so much, I can understand that with software you buy because it needs to be compatible with the world and those sorts of things. It's the software that you have developed yourself, your own in-house software, which is for my business. I would say we are almost an intangible asset business in that sense. So how would you put a depreciation, how to get the value of your software is one thing, but how would you be able to put a depreciation on software that you have made yourself?
Yeah, so like I said, so that would, if you put it as an intangible asset, so you value it as an intangible asset, basically the rules are it only has a lifetime of 10 years before it has to be completely, the asset has to be completely amortized. And again, you can, like I say, you can shape it. And again, my version is it's quite flat for the first few years and tails off. I think the thing is, does the asset stay the same? And it probably doesn't. I think what happens is you start with an asset and you continue to develop that asset. So after 3 or 4 years, even though that asset's solving the same problem and may actually have exactly the same customer interface, the engine behind it has changed considerably. So therefore, that 10-year rule drops because it would start to depreciate or amortize because it's an asset, and then it would go back up again because it's not the same asset it was. It's changed. So that would be my take. Is it would slowly depreciate or amortize over the first few years, but then because you're developing it continually, it becomes a new asset, just in the same asset class as the original piece of software.
Can I just ask a question to Jeff? Jeff, is there, if it's so disadvantaged, there's such a big advantage in tax purposes for UK startups or scale-ups or businesses to declare their intangible assets. Have you heard of anybody moving to other European cities, or whether it's Berlin or Tallinn or wherever?
Yeah. I haven't got in the bit of the sector that I sit in. I think that's probably unlikely. Typically, in the smaller sector, people value their businesses, but what people are trying to do is look. They're trying to do two things. If they're just using it as a lifestyle business, they try to keep their tax down as much as possible. If they're running their business to sell, they try to keep the profits up as much as high. And that's generally a sort of policy. And typically, you have a sort of 3-year run into a sale, and that period of time you do it. The policy changes and gets a little bit more inventive. As far as moving, the challenge to move a company is quite a large thing to do, to move a company. So it wouldn't be something that was done lightly. Because it's an expensive and cumbersome operation. So I think that's just for the simple ability to recognise assets a bit more. I think that'll be a bit extreme. Doesn't mean they won't do it. People do very strange things, but I think that will generally be a bit extreme to do.
But maybe starting up in another city in the first place.
Yeah, that's completely different. When if you're doing a startup, you would follow it you would choose a location, especially if you've got the end in mind of what you're trying to do. If it's a float, whatever, you'll choose the end in mind about where you're going to be based. That there was a few years ago, they did a comparison of UK listed companies and American listed companies, and what they did was they said, based on the same figures, based on the same amount of information, which of the two companies shows more profit. Now that's completely illogical. If we regard accounts as a science, well, the numbers are the same, the profits should be the same. Well, under US accounting policy, the profits were 30% higher in the US and the UK. Now, that is, if we think about the logic of that, it's probably completely consistent with what David is saying, and saying, well, actually, there's an incentive to capitalise it. So as a result, they are going to show they are going to show a higher, they're going to show higher profits, because actually the same cost is going through, but instead of it going through as an expense, it's going to, or debit, whatever, instead of it going as expense in the profit and loss account, it's going to go as an asset in the balance sheet. So they get to the same sort of conclusion. So that, I think that's completely consistent. The trouble is, if you're looking to, a German investor is looking to buy a company and looking under UK rules and one under under American rules, they're going to be quite confused, and they're going to sort of go back to scratch about what's going on. So it doesn't, from an international transaction point of view, I suppose it does make things slightly more complicated.
Interesting. Thank you very much. Very good. Good. Okay, so I think we're. There's another question come in. Sorry, Helen Kesson from Helen Tanner. Hello, Helen. Thank you. What is your experience of valuing data as an asset? Either you, David, or Jeff.
Well, if I start, if we think about what the future value of companies are, what's the biggest asset in the, if we're looking at where businesses have evolved, and especially if we're thinking about maybe the Trump previous election campaign and the Trump current one, the whole valuation is going to be based on data. The whole valuation is a number of contacts people have got, and so it's actually, this isn't shown under either of the examples, but actually the most valuable thing is data long term. At the moment, now things change, but at the moment, I think data is the biggest value. But now valuing that, well, that's why sometimes you see businesses being sold for amounts that are completely random. One of my clients a while ago sold their business. They had an artificial intelligence business. And it was great with the software, and it all did very nicely, blah, blah. And they were making a bit of money as it was going along, and they wanted to sell the business. And in order to sell the business, they gave the product away free. They stopped their revenue line. Now that's just, from an old school accountant, from an old chap sitting in North London, that's like completely random. You run a business to make money. Why would you switch your revenue off? But in 2020, that's 2019, when the world was a little bit more normal. It was all about, by that particular case, it was all about the number of customers they had. It was all about their data, nothing to do with their revenue. And you can't say that business was sold on a multiple. That business lost money, but it created a really good value. So I think that question was a really relevant question. I think that the valuation of data is massively important.
Yeah, it's also quite difficult because there's this issue of straight data, such as customer list, is not allowed. This asset, you have to be able to prove how it's going to create value. Yeah. So absolutely, as Jeff said, there's some data which in fact, it could be exactly the same data. Sainsbury's collect the same data as Tesco's. I think we all agree Tesco's data is worth more than Sainsbury's because they're better at using it. So I think it's that, how are you going to use that data? How is it going to create future value? And I think that's the basis of how you value it, I think.
Good. Does anybody, we're kind of running out of time a bit, but please, there's time for another question if you want, if anybody's there, just thinking of questions. But likewise, we can you can talk to David and Jeff afterwards directly. And David, if you want to just sort of sum up and just say that you've got the right contact details.
Absolutely. So just a very quick, which I think we've probably covered, just how we can help, and hopefully any of you going forward, we can help you understand the potential value of unclaimed intangible assets that a company has. We can capture that value. So, if you chose to put it on your balance sheet, you could. But again, as Jeff said, there's the sort of the front page of the balance sheet, and then there's some appendices at the back where you could also put this information. And we can help because we actually capture what these assets are and what you do with them. We can help a business make the most of what they already have. And obviously, if you want to understand the tax implications, Jeff at JLA is the gentleman to talk to. And then just the last slide is very simply. So sorry, Jeff, I just took a snapshot of your webpage and you're on it. So
that's
not
right.
my fault.
We always like our old photographs. They always look better, don't they?
So there's Jeff's website. And you can see it on the top in the green box. You can click there to talk to Jeff, and then our website again. We've got the big orange button, and as Charles said, you can book a free consultation, 20-minute chat, to sort of take a deeper dig on what we discussed today. So that's it for me. Thank you, Charles.
And likewise for, we're going to have other sessions. I think this is a really interesting topic, intangible assets. So we probably have another webinar this year with maybe the same speakers and one or two others, more of a sort of debate session. So if you're interested, anybody who wants to participate in that, or you got any burning issues in the non-financial due diligence area, what we call true diligence, because we believe that, financial and legal due diligence is a lot of large companies and small companies, but we believe just doing financial and legal due diligence is a bit like buying a car without looking inside the engine. And we feel that we can do, particularly John Gelmini and myself and the other team, and we've got a whole team of non-financial due diligence consultants, and whether it's in manufacturing area or in PR or in branding or in we've got AI. We're doing another webinar on the 5th of November with Reed Smith, the American law firm, and UiPath and Wizard, the AI firm, talking about why does 60% of companies say they have AI and RPA when they do not. So that's the webinar. We want to do it physically in the office. Hopefully we can do that physically in Reed Smith's city office. And also we hopefully want to have a drink session at Christmas as well with them. But we probably want, so anybody who has any bright ideas for other future webinars, we have a few in mind as well, which we haven't announced yet. We really want to make this into a global community where we all share ideas and we all enrich our understandings of business. And it's also a very natural, informal networking session as well. And we hope we can bring it offline as soon as possible. So if you want to reach out to myself or events@truedil.com or charles@transactionfocus.com, please do. But thank you very much for joining us. Thank you very much, David and Jeff, for really great presentations. You're both really, really brilliant people you've got a real passion for what you do, which just shows. And it's very insightful. And thank you very much to my team for organising it and for everybody coming on. And please share this, because Sylvia's doing a recording, so you'll be sent a recording, and just share this on. So we want to expand our community, and then we'll do as you said, a LinkedIn page where we can share further ideas. Because I think personally, we believe that this area is, like everything from the States, the HMRC are now beginning to get interested in this. We believe that the Financial Reporting Council will get more interested. So this is a growth area, and what we're hoping to do is to tackle and address and discuss and share ideas about growth areas. That's what we're about at TrueDil. Thank you very much. Bye-bye.
Right. Thank you, Charles.
Thank you.
Mm-hmm.